Hi, this is Scott Schubert, and welcome to lesson number 7 in our series of free Forex trading videos. Today we're going to talk about another one of the great secrets of success in Forex trading, and as with many of these secrets that we demonstrate and reveal, most of them are actually slap in the face obvious once you see them, and it's actually amazing that everyone doesn't know these things and practice them in their own trading business. So this is not a secret. It should not be secret, and yet very few people do it. So we're going to talk about one of the things that differentiates successful traders from unsuccessful traders, and our course demonstrates many of these things that differentiate the successful from unsuccessful traders. So the thing that we're going to talk about today is called backtesting, and it can also be called simulated trading. And what it involves is, consider this, if you're going to be in the business of Forex trading and you intend to be successful in that business, might it have occurred to you that one of the things that you might do to become a successful trader is to simulate trading your trading method on historical data? Rather than just waiting and trying to do it as you move forward in time, you could actually simulate trading it on historical data. Funny how so few people actually spend the time to do this. One reason why few people do this is because it's a little bit tedious and it involves some work. Now, if you've ever owned a fast food franchise, if you've ever owned a manufacturing business, if you have ever owned any kind of business, if you own a roofing business or a plumbing business, or you own a hairstyling business, any kind of business, obviously you would be laughing at the people who say, oh, that's too much work. I don't want to have to do that. Here you are with the intention of launching a multi-million-dollar business. You intend to start a business, and you intend for that business to be successful and grow into a multi-million-dollar business in a relatively short period of time, starting with very little capital and very little work. And yet people will say, oh, I don't want to have to backtest. I would have to actually sit down and work for a few hours. So you might want to get your priorities straight and focus on the positive, because if you're one of those people who does not have success consciousness and does not practice positive thinking in your business, you might want to start there. Start training yourself with success training that doesn't have to do with Forex, and start training yourself with positive thinking training, because you will need that before you will ever be able to have success. So you intend to launch a multi-million-dollar business. You might want to sit down for a few hours, maybe even 2 or 3 days. Oh my God, that you might have to sit down and actually do some work and put some effort into learning how to trade. So let's just talk about, how do you do this? I've had a lot of our students were amazed at this concept and were excited about trying it once they learned about how to do it. Backtesting. Well, how do you do that? Here's how you do it. You pull up a chart with the setup for how you intend to trade, and this is how successful trading methods are developed, by the way. You could actually develop a successful trading method in the process of doing this. And then you scroll back to the beginning of that chart in time. Depending on how much data you have, and depending on what period of time you're looking at, it could be several days, months, or several years of data that you could scroll back to the beginning of that chart. And let's just say for demonstration purposes, and to make this simple, that we have a trading method whereby we are going to apply a stochastics oscillator and nothing else, and we are going to buy every time there is a bullish reversal in the oversold zone, and we are going to sell or close our long position every time there is a bearish reversal in the overbought zone. So what that means is if price makes it down into this zone and the blue line crosses the red, we will buy, and if the stochastics makes it up into this zone and the blue line crosses the red, we will sell. Now, obviously, that's not our trading method, but if you were to do this, you would, if nothing else, you would learn a lot about how stochastics can be useful in your trading business and the limitations of how stochastics could be useful in your trading business. You would learn things like when you're in an uptrend, you might not want to sell. When you get a bearish reversal in the overbought zone, you would learn things like that, as we are about to. And so here's what you would do. You would say, okay, I'm starting at this point in time, and here's where we are. And then you move forward one candle at a time. Keep moving forward. And this is, as you can see, this is back testing. We're testing a trading method on previous historical data, and we're also simulating trading it. So we're simulating how to trade. So here we got a bullish reversal. Stochastics was not quite in the oversold zone. Make a note of that. Maybe you might want to change your strategy and say, well, if it comes close to the oversold zone, I will buy when I get a bearish reversal. And that's how you would learn this, right? Or you could just take someone's word for it, buy a course, and do whatever they say. But this is how you actually know for yourself how markets behave. So here we had a bearish reversal in the overbought zone, and so we would enter the market at that time. Then you would take out your notebook and you would write down the price and the date and time and the fact that you're entering the market and you're selling and going short. And then you would move forward, and here you got a bullish reversal. Is that your exit signal? I don't know. We're talking about testing a trading method or developing a trading method. That could be your exit signal. So you write down at that point the price, the date and time, and the number of pips profit or loss. And then you move forward. Keep moving forward. And then you learn something very valuable here about the concept of false signals. False signals is something you might need to know about, because as you move forward in time, you will experience this, right? So you might want to experience it now without risking any money on historical data. Here we had what's called a false signal, at least for this method. If this was a method, stochastics was in the overbought zone, the red line crossed the blue, and you would go short, and yet the market continued up. And then it crossed again. So maybe that was a false signal. You write that down, you write down the results of that, and then you go to the next one, and then you would go short again the second time you get the signal, and this time maybe it turns out to be a real signal. So you write down here date and time, the price, and the fact that you're going short. Move forward, and as you move forward, you're learning something. You're learning how stochastics behaves and whether or not this might be a profitable approach to trading, and you're learning how this indicator works. And depending on what trading method you are using, you might find all different kinds of results. You want to do this process It's tedious. It takes time. It is a job. It is a part of doing this business, obviously. Would you want to start a business and never do this? How will you know what to expect moving forward in time if you haven't looked to see what's going to happen if you did it in history? And as the CFTC politely reminds us, past performance does not guarantee future results, but when you learn our trading method, you will discover that there are certain principles that always occur over and over, and most likely always will occur over and over. Although the market is always doing new and different things, it is doing new and different variations of something within the context of certain patterns and certain things that occur over and over. So as you go through a process and you backtest a trading method and you document the results, you will learn how to trade that method. So if you start off with a method and you never do this, you will learn by trial and error moving forward in time what you could have learned by looking at this on historical data. Which would you rather do? Would you rather be prepared and know what to expect? And the funny thing is, many traders, as they are looking at the market, they see things happening and going, oh, this is so unusual, when it has done the same thing like one day earlier and has done that same thing continually throughout the history of the Forex market. Well, you would know that if you had ever looked at charts and gone through historical data and tested a trading method, right? So this is one of the things that I will reveal to you here for free, because it should be so obvious to everyone, and yet very few traders actually go through this process. And our trading community includes some of the most successful Forex traders in the world. At least that is my belief. I'm not sure how I can document that, but based on my own experience and anecdotal evidence of talking to people in numerous different Forex trading programs, taking different trading programs myself, attending different seminars and participating in different Forex communities, it is my belief that our students are getting some of the best results by far in the industry. And so the people in our community are well familiar with this process and have gone through this process, so that when they actually trade in their live accounts, as the market moves forward in time, what they see will not be that surprising to them, because it will always tend to be different variations of what has happened in the past. And so now it should be very obvious to you that one of the key differences between traders who are successful and have consistent profit and traders who are not successful and do not have consistent profit might be whether or not they have spent time backtesting a trading method. So this is one of the things that you would do when you're starting your business, and part of the process of learning how to trade. And it's like a homework assignment that you would do it on your own time. Of course, this is your own business anyway. So you would set aside the time to do this as a part of the launching of your business, as a part of the development of your own skill as a trader. And once you have gone through this process, you will be able to say, this trading method theoretically has a such and such percentage win to loss ratio. It has a such and such percentage risk to reward ratio. This would be the actual result in my trading account, the percentage of increase that I would get by trading this method, and also taking into account how much time you are able to spend trading, and only documenting these results during the time that you would normally be trading. Would you want to know what the potential results are for a trading method in advance of risking your real money trading it? Or would you want to just open an account and see what happens? Well, I would think that you might want to know in advance what the potential results would be for a particular trading method. And this is how you do it. Until the next time we get together, I'm wishing you the best of success in your Forex trading business.